Provident Healthcare Partners is a healthcare investment bank that is focused on transaction advisory services. We created this podcast for healthcare executives, entrepreneurs, shareholders, and providers who are interested in learning more about the world of healthcare consolidation.
Thanks to everyone for tuning in to our most recent podcast. Today's topic is on the aesthetic space. Aesthetic medicine, med spas, plastic surgery groups have been organizations that have been very highly sought after and highly discussed in the area of healthcare M&A over the past several quarters. Just overall, the aesthetic space sits at a pretty interesting crossroads of consumer demand for services, overlap with traditional healthcare services, which has been highly invested in over the past several years. And just the growth dynamics of the space have led to a lot of investor interest. And at the same time, a lot of transaction options from a sell side perspective compared to years past. So the goal of today's podcast is to provide our listeners with some context and background on why there is so much activity going on within the med spa space today compared to years past, a flavor for how transactions work within this vertical, as well as the best ways to prepare for a transaction process as an owner. Here at Provident, we're lucky to be joined by a few colleagues from Dykema, which is a national law firm that's very well renowned for their work within the aesthetic space. And the two individuals joining us from Dykema today are Craig Woods and Dean Gould. Craig and Dean, we appreciate you guys being on today's podcast. Feel free to give the listeners a quick background and overview on yourselves as well.
Sure, absolutely. AJ, thank you so much for that kind introduction. As you mentioned, my name is Craig Woods, and I'm joined here by my colleague, Dean Gould. We are both members of Dykema Gossett. Dykema is one of the largest and well-recognized firms in the country, and Dean and I in particular specialize in healthcare transactions. I head up our healthcare M&A team at Dykema, and Dean is a senior attorney in that group. We have about 125 professionals that provide some level of service into the healthcare space, and we regularly advise sell-side clients in the aesthetic space, as well as larger sponsored platforms also in the aesthetic space. So we're really excited about the opportunity to speak to everyone today. Hopefully, our listeners will take away some valuable information that they can use in their practice.
Yeah, appreciate it. Thank you, AJ, and thank you for having us, and thank you for the listeners who have tuned in. As Craig noted, I'm a senior attorney with Dykema. I work closely with Craig on numerous healthcare transactions, including in the med spa and aesthetic space. And it's a really exciting, newly developing vertical within healthcare, and look forward to discussing what we're seeing in the marketplace today.
Great. We're very appreciative to have both of you and your insights to this space on today's podcast. Just for the listeners, my name's AJ Shekar. I'm a director with Provident Healthcare Partners. I spend a lot of time in the multi-site healthcare services arena, including the aesthetic space, which has been an area that Provident has had some experience in the past and have been doing a lot of work and advising groups in the sector today. I have a colleague with me, Stephen Grassaare, who has been working closely with me and the rest of the team at Provident on some of our aesthetics engagements. And I'll let Steve give his background and introduction as well.
Thanks, AJ. I'm a vice president at the firm. I work very closely with AJ, heading up the aesthetics vertical within our healthcare services practice. It's a category that we have a lot of enthusiasm for, and so excited to get right into it.
Terrific. So I think first and foremost, common question we get from entrepreneurs in the aesthetic space is that there's a ton of outbound outreach coming their way, whether it's from private equity groups looking to make an investment in their business, a group that has been already backed by private equity looking to join forces with their organization, and even others like investment bankers, business brokers, and other participants in the space reaching out about M&A activity within the med spa and aesthetic vertical. Steve, maybe you can start us off and give a quick overview and background as far as why this space is becoming, so attractive to the investor universe today.
Yeah, I mean, when you think about the investor thesis for the space, there's some very clear business model attributes that make it appealing from an investor and business owner standpoint, frankly. For one, it's incredibly fragmented and relatively nascent as well. Half of all med spas have really only been in existence over the last call it 3.5 to 4 years or so. There's now over 5,000 med spas across the country, depending on how you categorize certain business lines. But 80% of those are single unit, single clinic. So there's a tremendous opportunity to consolidate and roll up a lot of these businesses. Then when you think about consumer demand, it's been off the charts recently, and the demand has far outstripped supply of practitioners in the space. There's been growing acceptance, essentially no stigma anymore, and just explosive growth in volume, particularly on the injection side of the house, which has even expanded into more categories. There's been growing acceptance within the male cohort of clientele. Younger demographic is the fastest user of services today. And so just a lot of tailwinds that make it a very attractive space. And then from a margin profile and unit economic standpoint, far and away better than pretty much every other pocket within healthcare services. It's a cash pay business model, recurring revenue streams, very CapEx light model as well. And so just overall, it's just been a very scalable business with a replicable model.
Totally agree with you, Steve. And I think some of the aspects that get investors excited about the med spa and aesthetic space, piggybacking on some themes we've seen in other practice management verticals like ophthalmology and dermatology, GI, et cetera, is that for those groups that have a significant patient consumer population in a given geography, there's the ability to layer in pretty profitable ancillary services on top of their existing business model. And so there's really kind of two ways that investors have looked at those ancillary services, and it's based on, the model of the company itself. So for those non-invasive oriented groups that are doing mostly neuromodulators, doing filler injections, et cetera, there's the ability to leverage that captive audience to layer in services like weight loss, laser services, and other kind of body contouring, non-invasive type services as well. And then on the flip side, for the more invasive plastic surgery oriented groups who have patient population that's coming in for surgeries, there's the opportunity to layer in the neuromodulator side to increase kind of recurring patient visits, as well as the cosmetic laser and body contouring side of the business as well. And so the ability to, again, increase the total share of patient wallet is an attractive element of this space and piggybacks off of themes we've seen in other practice management verticals. But I think at the same time, as groups have built out their thesis within these various service lines, there has been a bit of a divergence in terms of groups that are more focused on kind of the injector-driven model. You think about the groups like the Skin Spirits of the world who've been very active on that front, and the med spa partners, while others have taken more of a kind of comprehensive approach, focusing on the plastic surgery side of things with kind of the logical ancillaries of Botox and other neuromodulators like Athenix. So it's been interesting to see how investor interest has kind of transformed over time, where there's obviously a lot of different service lines that groups can focus on, but their thesis has changed a little bit from model to model. Craig and Dean, I know you guys have been working with a lot of independent groups as well as advising groups on the buy side as well that have been making investments into the space. So we'd love to hear your perspectives on the rationale you're seeing from your clients who are either undertaking investment or doing the investment themselves in the space too.
Yeah, thanks, AJ. I mean, first of all, the summary you provided as far as the rationale for investor interest is spot on. The few things that we see on our side as to kind of what's driving this rapid growth and consolidation is just really the fragmentation in the industry. Dean and I work closely in a lot of other verticals and have kind of been there throughout the life cycle and kind of the current evolution of a lot of different healthcare specialties. And when you look at what's going on in med spa, this is kind of like dental 15 years ago in many ways. You have a lot of independently owned small groups out there that have grown a bit, but have not really consolidated in any meaningful way. Obviously, you have an industry that has grown significantly over the last 4 to 5 years, but you don't have a lot of sophistication right now in the med spa space. And now I don't use sophistication, that word, to suggest or to insult anyone, but it's just that a lot of these groups that are out there, there's just not a level of sophistication that you've seen in some of the other healthcare verticals that currently exist. So I think for investors, they see those opportunities. They've seen an opportunity to provide some of that guidance, to bring these kind of disparate resources together under a single roof, and then to work with them to innovate and to grow. So I think it's interesting. We saw it in dermatology, we saw it in vision, we saw it in dental, and many of those industries are continuing to grow. But this really is very comparable to dental 10 or 15 years ago. And I think a lot of investors see where dental went and they say, well, if med spa can follow that same trajectory, that's an attractive place to be. I think the other couple of things that you're seeing that probably drive the investor thesis here is that one, there seems to be a lot of innovation in the aesthetic side. Across all healthcare verticals, there's a lot of innovation, but we're seeing a lot in the consumer-based cosmetology type services, aesthetic services. There just seems to be new products, new technologies that are coming out every day. And then I think the other thing that is driving this is simply the barriers to entry for med spa and aesthetics. There seems to be less of those than what there are in some other more established healthcare verticals. In particular, things like corporate practice of medicine and other state-specific kind of regulatory hurdles, they're just less well developed on the aesthetic side than what you might see in other more traditional healthcare verticals. Dean, anything on your end that you're seeing that perhaps is a rationale for investor interest?
Yeah, absolutely. I think one thing we hear a lot within med spa is that it's a healthcare vertical because of the use of injections, and we have to be mindful of those regulatory considerations, as you mentioned. Perhaps not as much as more traditional healthcare, but certainly something to take a look at. One thing that investors love about the space and that they don't particularly love about more traditional healthcare is the all cash pay here. One of the difficult parts of being a healthcare investor is working with commercial payers, working with the government to ensure that there's going to be a steady revenue stream and no interruptions with that based off of negotiations with those payers. But within med spa and aesthetics, it's all cash. They're able to mitigate their risk when it comes to reimbursement. What we're seeing, surprisingly, within the industry is inelastic pricing. Forecasts show that this is going to be recession-proof. So I think with the cash pay, the steady revenue stream, and I think with the risk that potential recession may not affect revenue as much as anticipated, I think is continuing to drive investors to the space. And we're seeing the same investors that are involved in dental, as you mentioned, Craig, involved in other healthcare spaces that are now invested into med spa. So you've got Leon Capital, KKR, Shore Capital, folks that you see in traditional healthcare verticals have made their entry into med spa. So they're able to replicate that success with other multi-site healthcare verticals and now take their institutional skill set and move it into med spa. So it's really exciting.
So naturally, all this interest from the buy side perspective skews supply demand imbalance in favor of sellers, right? So more private equity demand than supply of scaled businesses in the space, which makes the environment very seller friendly, as we alluded to. What would be the rationale for a business owner then that's benefiting from these tailwinds to embark on this process and explore, what their options may be? And maybe we can start with Craig or Dean on that one.
Yeah, for sure. I think the rationale for sellers, you don't want to say it, but the cash, right? There's opportunity to make life-changing money for some folks. So I think that's rationale number one. There was a limited marketplace when you're running a med spa 5 years ago, and the only person that you would potentially sell to is another entrepreneur. And so the overall marketplace was smaller, and so the prices were not as high. And so now with increased demand for these businesses and with private equity involved, there's just more money out there. So it's an exciting opportunity to be a business owner in the space because the opportunity to get a big cash payment is bigger than it was 5 years ago. But aside from that, the opportunities to grow and partner with these groups is really exciting as well. Unfortunately, entrepreneurs that are running multi-site rely on capital from debt capital and perhaps some equity capital from other folks, but it's nothing to the level of private equity. And so here now they're able to take that partner and able to grow new de novo sites. They're able to use those dollars for marketing, which is a critical aspect of med spa services, and then also use that capital to help grow the business through other M&A activity. There is rationale, obviously one being the big cash payment, and then also the ability to partner with a group that has institutional knowledge on how to grow and scale multi-site healthcare platforms.
Totally agree with you, Dean. I think that institutional knowledge is a big piece that groups think through in terms of rationale to do a transaction. I think a lot of individuals see the fact that there's pretty significant personal risk tied up in the business, especially when entrepreneurs are signing personal guarantees on new leases. And so the ability to mitigate some of that business risk, especially in highly competitive areas with low barriers to entry, can be a pretty strong rationale to do a transaction today from a sell side perspective. And I think to your point earlier as well, given how much capital is chasing the space, valuations are very favorable among some of the higher valuations we've seen in healthcare services today. And so there's the ability to monetize while valuations are very seller favorable, and also retain equity in the business that stands to grow with the help of a partner that can provide those resources to go out and do de novos and acquisitions. I think some of the biggest success stories we've seen are some of our clients who have been first movers to some effect, being the first in their market or within kind of their sub-vertical to take on private equity, being able to leverage that additional firepower behind them to go out and capture market share at a quicker rate than their competitors have, either through de novos or acquisitions, and ultimately seeing a return on their retained equity in the business equivalent to, if not greater than, the initial liquidity event that they had at the initial transaction. And that first mover advantage, being early in the investment cycle, offers a lot of different options outside of just kind of the value of rollover equity with a partner. There's a lot of options for a platform caliber med spa or aesthetics practice today. There's certainly a lot of strategic players who have taken on private equity that are looking to expand through de novo means and acquisitions as well, but lots of private equity interest at the same time. I think what we've seen in other subverticals of healthcare is that, call it 4, 5, 6 years on in the investment life cycle, there's more and more private equity backed players, and the new investors who are looking to get into the space might shy away from platform caliber opportunities just because of how much competition there is for bolt-on acquisitions and even de novo growth in certain markets. So some of the groups that are earlier on in the investment cycle have a little bit more flexibility in terms of either becoming a PE platform in their own right or joining up an existing consolidator as well.
I was just going to add, those are great points, AJ. A couple of things too that we note that are, I think, really important and attractive for private equity groups in particular who are trying to identify targets that are attractive to them. First and foremost, Dean mentioned earlier on the marketing angle and that investment in the marketing side that a private equity group or an independent sponsor might provide. But the flip side of that is that many of our med spa and aesthetics clients, unlike some other healthcare verticals out there, we find that a lot of them are very, very social media savvy. And I think that is an important factor when private equity groups are looking for attractive investment opportunities, because many of the entrepreneur owners of these clinics have been very active for a long time on Instagram, on Twitter, on Facebook. They know how to market and they do it really well. And the other thing is that there is a lot of name recognition in the space, meaning that a lot of these entrepreneur clinic owners, they may be multi-site, they may be a single site, but the name that's attached to their site is typically pretty well known if they're good at what they're doing. They have attractive marketing, attractive signage, they're in an attractive area just from the real estate angle. And so I think that also for groups that are looking to grow, that are looking to partner up with someone and kind of build from there, a lot of the challenges you face in the other healthcare sectors where they're located, location in particular, just the marketing angle may not be as well developed. Here with a lot of the med spas, we see the opposite. We see people that have great name recognition, which means that if one owner joins with a private equity group, that group can expect that owner might bring more deals to the table just because their name recognition in the space. Their marketing is maybe better developed. And then we also see just in things like aesthetics conferences that we go to, and this is all anecdotal, but you notice at these conferences that there are certain people that just have a big name in the space, in the aesthetic space. Everyone seems to know who they are. They may only have 1 or 2 med spas for their name, but they have done a very good job marketing. And I think that they have made themselves or put themselves in a position to be very attractive to outside investment.
Yeah, there are a number of common themes that come up when we speak with private equity firms and strategic consolidators as to what the attributes are from a business perspective that really get folks excited. And to your point, brand and marketing is probably one of the biggest. And, I think it's especially important as an independent organization that clients are coming in for not one particular rock star injector, but for the brand itself to help mitigate key person risk. So buyers will like to see expansive mix of revenue across a number of different providers instead of just one injector making up, call it 75% of total volume. And there are a few other themes that have come up as well when speaking with groups. I think first, in having a multi-site, multi-unit presence is really important as well. The unit economics for de novo growth in the space is very, very appealing. So if you can point to an ability to grow and scale into other markets, that's viewed very favorably from the investor community. The market or geography itself is very important. So what does the population growth profile look like? What's the demographic profile? What do household income figures look like in a given MSA or market? Growing markets that skew younger and more affluent are, naturally more attractive market for these types of services. And then I think the biggest one, in my opinion, is human capital and ability to recruit and retain high quality talent, because there is such a supply demand imbalance in the space. So looking at things like W-2 versus 1099, what's your track record of recruiting and keeping injectors, turnover rate, provider churn, those are key diligence areas from buyers through processes. Are there non-competes in place? What is the level of experience that new hires come in with? What's training like? Buyers process all of these factors and attributes when evaluating opportunities, which sort of bleeds into the clinical and operating model as well, which I know AJ had some thoughts on that.
Yeah, absolutely. It's interesting because in the aesthetic space, it tends to be a very APP driven model where there's a significant amount of kind of revenue production from NPs, PAs, RNs who have, Craig, to your point, in a lot of cases, their own significant kind of social media following or presence among their consumer and patient populations. And I think what we tend to see in those types of models is investors being very keenly interested in what kind of the compensation formula is for those types of providers. Is there an opportunity for productivity-based compensation? Is there a pathway to equity for those individuals? And from a retention standpoint, and especially given kind of the APP driven models here, is there a solid continuing education program, ability to do kind of case review, et cetera, internally as well to create professional satisfaction and growth among APP driven providers as well? And some of the operating model considerations, it becomes a bit of a different thesis point buyer by buyer as well. Certain groups are very kind of focused on the injector driven opportunity with the neuromodulators and fillers, et cetera. And then others are more keen on plastic surgery type options where there might be some concentration risk that groups look at with a single plastic surgeon that's accounting for a significant piece of revenue and earnings. And certainly if that individual is a shareholder or even an associate provider in the business, similar to other physician group transactions we've done, investors are going to be very keenly interested in ensuring that those significant producers in the business are tied in some way, shape, or form towards ongoing productivity and potentially a shareholder status in the business going forward too. And so a lot of these kind of diligence points outside of your typical financial and operating KPIs around just alignment of interest between providers, the top co-organization and investor are really key themes that buyers diligence as part of the transaction process.
What about deal structure? I'd imagine most listeners are likely business owners that haven't gone through a process of transacting or taking on institutional capital. Craig or Dean, would you mind shedding some light on where you've seen typical deal structures shake out in the space?
Yeah, absolutely. Since it is a healthcare transaction, because we have the injections and the business is generally within the state, it's located, governed by the Board of Medicine. Buyers in the space would be restricted, and this is generally, it's state specific, but generally the investor buyers would be prohibited from owning the business directly because of a concept called the corporate practice of medicine, which prohibits non-doctor or non-provider ownership of a medical practice. And so in order to facilitate the investment by the private equity or sponsor, these investors set up what's called a practice management structure, a management company structure, a management services organization. And what it allows for the investor to purchase and invest in the medical practice by acquiring all of the non-professional or non-clinical aspects of the business, which is the vast majority of it. So that's where the big cash payment comes for. And then what happens after is that management company partners or contracts with the medical practice and provides a suite of non-clinical support services, like we discussed, marketing, but also HR and other support services in return for a fee. And that fee is usually commensurate with the buyers ultimately purchasing in terms of a revenue stream. And so what happens is there's this workaround essentially to allow for non-doctor, non-provider ownership of a medical practice. In some states, some listeners may know that their state doesn't have restrictions on the corporate practice of medicine. In those states, buyers may set it up to where the institutional investor just buys directly. Given most states have some sort of regulation, they use that management company structure. And then also to align incentives, the seller will also reinvest in that management company and receive what's called rollover equity. And then that rollover equity will hopefully be monetized in 3 or 4 or 5 years when consolidator goes and finds another partner and sells their interest. So yeah, it's set up substantially similar to other healthcare verticals with this management structure and similar to any other type of private equity backed business where there's aligned incentives with rollover equity.
One other thing to add there on the structure that's 100% correct, Dean, is that with the seller, though, the clinical owner, oftentimes too, there's some thoughts that need to go around how will the clinical side be structured as well on a going forward basis, as some buyers will prefer to keep the existing clinical entities in place. Some will actually ask that new ones be formed. And oftentimes what's going to happen is that the former owner of the clinics, will then have an employment agreement on a going forward basis with the entity that they formerly owned or with the new clinical entity. It's just a standard part of the transaction that will lay out some of their kind of day-to-day compensation, their salary, and how they'll be compensated on a going forward basis. But for the most part, the compensation is going to be realized in the form of cash consideration at close and in equity that's going to exist not in the clinic anymore, but will exist at the non-clinical entity at the management company level, typically in a form of holding company that would exist above the management company.
Yeah, those are great points, Craig and Dean. I know we've spoken with some investors who have also kind of had the question of how does the legal structure of, these roll-ups work within the med spa space, given that it has some different elements to the more kind of reimbursable healthcare side of practice management. I think the creation of rollover equity and cash at close in terms of the valuation methodology is still pretty similar as well to other areas of multi-site practice management, where the typical calculation of enterprise value is looking at the adjusted EBITDA, earnings before interest, taxes, depreciation, amortization of the business times a multiple, yielding the overall enterprise value of the business, which is then divided up in terms of cash paid to the shareholders at close, rollover equity in the parent company or MSO. And, similar to other practice management areas, the adjusted EBITDA calculation will account for certain things like one-time, non-recurring, discretionary type expenses in the business, but kind of a common exercise that we undertake on behalf of groups looking to explore a transaction process as well is thinking about certain pro forma items. So essentially projects or initiatives that the company has undertaken but hasn't yet borne the full fruit of financial performance perspective over the last 12 months. So these would be things like, for instance, newly hired providers that haven't yet ramped up to their kind of 12-month potential, certain vendor type contract changes, whether that be expense reductions from a supply perspective or other third-party vendors, ascribing any savings over a full 12-year basis, but also thinking through any kind of go-forward expenses as well. So for instance, if the company is at the stage of needing certain key employees that have only joined in the past month or two, thinking about kind of the full 12-month impact of those individuals as well. But really, I think the economic overview of, these transactions is kind of predicated on having kind of a solidly defensible pro forma adjusted EBITDA number, as well as leveraging competition to drive the multiple as high as possible, which kind of gets us to what's the best way to prepare for an optimal outcome in a transaction process like this. Craig and Dean, you've explained a lot of kind of key legal pieces in terms of the structuring of a deal that is important to get right on behalf of both sell side and buy side. There's obviously a lot from kind of an economics and transaction preparation standpoint that's important to be familiar with as well. But Craig and Dean, would love your perspective on some of the key legal and regulatory pieces that are important to have buttoned up front before you undergo some of these types of discussions.
Sure, no, I appreciate that. There's a few things that we see, and this is really not just specific to the aesthetics industry, but it's really to all healthcare transactions. The first thing that I would note is, as a client, as a seller is thinking about entering the market, or even if they're not, one of the things I always advise a client is to dust off their old governing documents. That means their operating agreement or their partnership agreement, and review it to make sure that it's up to date. I can't tell you how many times we get close to closing or as we're part of the diligence process in a transaction. And one of the items that a buyer asks for is for the key governing documents. We dust those off, we look at them, and we realize they haven't been updated in over 30 years, and that the ownership structure, the cap table, does not remotely reflect the current ownership of the company. And so I always say to clients, they should keep those up to date. It's almost like a will. You should look at it every few years, make sure that it's correct. And so that's the first thing that I would always recommend that people look at. The second thing is how you are classifying your employees. A lot of our clients on the sell side choose to classify employees as independent contractors because there may be some particular benefits to doing so. Obviously, whether someone is an independent contractor or an employee is typically governed by state laws, and there are tests in place to determine whether they truly qualify as an independent contractor. I'm not here to point fingers or to say anyone's doing anything wrong, but I will tell you that in the healthcare space in particular, it can oftentimes be very difficult to meet the requirements of being an independent contractor. So a lot of times what we will do is work with our client to make that determination in advance, because a lot of buyers will be asking that same question during a transaction process. And if they believe that there's any risk of misclassification of an employee, then many times they will ask to convert those independent contractors to employees as the process is going, or even post-closing. So we can try to minimize some of those headaches on the front end by looking at that with our clients. The other thing I would say, and look, there's a lot obviously that you can be doing on the front end. We'll do a deep dive with our clients to go through things and make recommendations. But in particular, one of the things that we like to look at is just how they're structured. I mean, the structuring of the organization today may make perfect sense for a client who has just had a few offices and never thought to themselves that they might engage in a transaction with a third party. But that same structure that works for them now may not work that well for them in a future transaction. There could be tax implications in particular with regards to how they are set up. And so what we will often do with a client is just look at how they're structured and make sure and just kind of map out what a transaction will likely look like and determine what the tax impacts to them would be today, and whether there are things that we can be doing tomorrow to help ease that burden on a client.
Yeah, and I think from a business perspective, there's few things you can do pre-process to best position the business for a sale. First of which is just operating the company as if you weren't exploring a sale. If you had, say plans to open a third or fourth clinic and were hesitant to do so because of, the short-term financial impact it may have, buyers are going to want to buy growing businesses and will give credit for some of that untapped growth that's not fully realized. And frankly, it would be our job as your advisor to control the narrative and show what the potential upside is 6, 12, 18 months down the line, modeling out the earnings contribution for some of those incremental clinics. And so to that point, pre-market, I'd say we absolutely need to nail down the growth narrative that we're bringing to market and make sure we have a clear, succinct message as to how we're going to take this business from $1 million earnings business, for example, to 2, 4, 5 million. Really kind of just fine tuning the story will be really important. Reporting is also another important factor as you go through this process, being able to track KPIs, data that ultimately helps us or helps you sell the story to the buyer universe. A lot of these groups are very data driven. And so the more ammunition you have from a data standpoint, the better position you'll be. And then finally, assembling a team of advisors to act sort of like your river guide through a process. Our role as an investment bank is to manage a competitive process from start to finish. There are other advisors as well that may come in handy, namely a quality of earnings firms that prepare third-party financial reports. I would say it's not always warranted, but in some cases it makes a lot of sense. And then having good legal counsel as well. Cannot overstate how important it is to have good attorneys that have done some work in the space on the deal. And so overall, having a very strong team of advisors in your corner through this process is one of the more important aspects of preparing for a transaction, because inevitably issues are going to come up in some of these deal processes. It's very rare you see a transaction process be smooth sailing from start to finish. AJ, maybe we could start with you before we get into legal issues. What do you see as some of the biggest issues that have come up on deals that you've worked on?
Yeah, I think one of the bigger issues that comes up in most lower middle market transactions is related to financial due diligence. So any investor or acquirer will do their own third party or internal review of the company's financial statements to substantiate the adjusted EBITDA that they are ascribing a multiple to get to overall enterprise value. Most lower middle market businesses, they may be on cash basis financials compared to post-closing, what most groups look for on an accrual basis. Also, a lot of groups may have miscategorization of expenses, et cetera, in which case, a lot of times as a buyer goes through their due diligence process, the accrual basis revenue and earnings doesn't necessarily match up with the cash basis numbers that most lower middle market businesses have, and especially in the med spa space. And so what we advise to do for a lot of groups as they undertake this type of process is potentially considering a sell-side quality of earnings analysis. And so that entails hiring a third-party accounting group that goes through and puts together an analysis of accrual basis revenue, accrual basis expenses, considers all the kind of one-time non-recurring items that factor into adjusted EBITDA, but then also vet out any pro formas that the business should be getting credit for in a transaction as well. And so having a caliber group that ultimately has a very respectable work product from a quality of earnings perspective can be very helpful in getting ahead of future issues in financial due diligence. And while that may not be an option for all groups, having an experienced advisor, whether that be an investment bank or an accounting firm or something along those lines, do a very deep dive on some of those cash to accrual issues can be helpful in mitigating potential issues down the road. I think outside of financials, there becomes always the issue of kind of philosophy and provider retention as a result of these transactions. In some cases, business owners may step into a transaction with, let's say, some trepidation over informing staff too early or providers too early. But ultimately, there are businesses where a significant amount of the go-forward value sits in the hands of the revenue generators going forward. And any potential investor or buyer will want to ensure that there is retention of those individuals going forward as well. And so what's important to think through if you're a business owner that has a lot of high-performing employed providers is to consider the best way of retaining those individuals post-transaction. We've seen a few different approaches between utilization of some sort of retention payment going forward, potential for equity for those individuals as well, and just ensuring that those providers are maintained through any sort of transition process and given an opportunity to succeed post-transaction as well. Oftentimes we kind of see and hear of issues where there's maybe more of a guarded approach in terms of informing those individuals pre-transaction, which leads to potential issues post-transaction. So it's always good to think through the best way of keeping those high-performing revenue generators incentivized with the deal. I think, it's also important to think through some kind of emerging legal and regulatory areas that have been, I'd say, most prevalent for groups that are doing more of the weight loss side of aesthetic services. I think there's been more concern today over kind of the procurement process that certain weight loss providers have, from obtaining their inventory from a compounding pharmacy perspective versus from the drug manufacturers directly. And so if you're a provider of those services, it's good to kind of think through your procurement approach and make sure that you have kind of third-party opinions on that process as well. I think because we're still early stages in the consolidation of aesthetic providers and weight loss providers, that's probably one of the earlier issues that we've picked up on, but important to keep up to speed with your regulatory attorneys and advisors on ensuring that you're mitigating any other kind of key legal or regulatory issues going forward as well. But Dean and Craig, you may have some other thoughts on kind of key things to look out for from a legal perspective as well.
Yeah, absolutely. Thank you, AJ. Once the deal is going and we have a buyer selected, the legal process becomes far more important. And legal advisors such as Craig and myself take it upon ourselves to protect the sellers in the deal process to ensure that there is limited exposure to the extent we can as it relates to purchase agreement and the other agreements. But taking a step back, when it comes to a deal process on the legal side, one of the key driving considerations that takes lead time and takes a little bit of effort on both the legal side and with our client are the third-party items. And those are items that we can't control directly with the buyer, items we can't control directly with our client. And specifically, third-party items that come up in any type of healthcare transactions are those with your landlord when it comes to the leases, and those leases being transferred to the buyer, issues with your debt providers, your loan providers, in order to get a payoff letter, because at the closing of the transaction, all debt will need to be paid off, and any type of encumbrance or lien on your business will have to be cleared. And so we have to communicate with those debt providers to ensure we get what we need. And lastly, most organizations have some sort of retirement benefit plan, like a 401k plan. And depending on how the buyer is set up, we would have to work with your third-party administrator, or whoever services your 401k plan or your pension plan, to ensure that it's properly transitioned or terminated, or however the buyer wants us to handle it. So those third-party items are the ones that tend to take the most time during a legal process, and the one that's out of our control. So getting ahead of those right when the deal process gets started is important. When it comes to just review of your deal documents, you're going to be presented with a purchase agreement, an employment agreement, as Craig mentioned, and then some rollover equity documents as well. In the employment agreement, the goal of a lawyer is to minimize the amount of liability or exposure that a seller has. And that's what we do. We negotiate back and forth. We take care of that on your behalf. Can't get rid of all of it, but we certainly work hard to minimize it. One other item that we know is prevalent within MedSpa and aesthetic transactions are earnouts, contingent consideration, or deferred payments. Within those concepts on the business side, the business folks get really excited. They base those off of metrics of EBITDA or revenue, but we want to make sure that the legal aspects are also taken care of. There's healthcare considerations and other considerations that we want to be mindful of when negotiating those deferred payments. In each of the three agreements that I described, there's going to be a discussion on restrictive covenants. The one that's discussed most commonly are covenants not to compete. The buyer is seeking to protect its investment by ensuring that you, the seller, will not compete with them following the transaction. But we want to make sure that's reasonable and not broad. And we understand the buyer needs to be protected, but at the same time, we can't be overly restrictive to the sellers. We could go on. I'm happy to, if any listener wants to reach out to us to discuss further or has a deal in front of them, we can discuss what these mean. But those are the key items, those third-party items, earnouts, and those restrictive covenants.
One thing too on that, those are all right on point. The other thing too that I would point out to anyone who's listening in is that the repurchase rights and the exit scenarios in connection with the rollover equity are critically important in any transaction. One, the equity that you will receive oftentimes will be subject to clawbacks for either indemnification claims or any other type of losses in connection with a transaction. So we work closely with you to try to minimize that exposure. The other thing I would tell you is that it's important for you to understand what it would look like for you upon an exit. Sometimes platforms are set up in such a way where you get to participate in the same way that the senior investor does. Others, there are more restrictions on the type of equity that you've received and how much you're going to be able to liquidate. and monetize upon an exit. And I think it's important for you to understand those options and what leverage you have to further negotiate those terms as part of your transaction. There seems to at times be a misconception by our clients, or it can be that, hey, I sold, I'm done, I'm finished, and I sold the company and now I'm out. But in many ways, it's actually just beginning. And so I think understanding that there has to be an alignment of interest with an investor, and the equity component, what you're getting in the deal, I think has to be closely aligned with that as well. And so just understanding those options and understanding what's going to be required of you as you continue to move forward. And then the other thing I'd tell you is kind of where we work really hard, both during the letter of intent stage and in the negotiation of the operative documents, is just to make sure that your exposure in the purchase agreement, in the equity agreement, in the employment agreement, call that indemnification rights, where a buyer can seek to recover losses from you for breaches. We work really hard to limit that exposure, whether that be caps on the types of damages that people would request, deductibles, essentially, that we would negotiate on your behalf, and just how long these reps and warranties going to last. How long will they be in place? Sometimes they're indefinite, sometimes they're 18 months. We just work really hard with you to try to limit your exposure as much as we can and within market.
Those are all great points, Dean and Craig. I think ultimately this conversation, we could go on for, I'm sure, hours on the various different topics related to the aesthetic space, opportunities we see for entrepreneurs and shareholders to take advantage of some of the positive trends going on, while at the same time being mindful and cognizant of key issues that could prevent a deal from getting over the finish line in an efficient way or in a seller advantageous way as well. But, we're looking forward to doing more podcast webinars, et cetera, with our colleagues over at Dykema on this topic in the future. But in the meanwhile, we're happy to kind of link contact information for Craig and Dean in the show notes, as well as our contact information as well. At the end of the day, this is a space that has been very, very active over the last few quarters from an M&A perspective. And, just based on our perspectives here today, we don't believe that that's going to slow down in the near term. So we're excited to continue the conversation around potential opportunities with folks that are interested, and looking forward to more educational topics around the MedSpa space in the future. Craig and Dean, we really appreciate your time in joining us for this discussion here, and looking forward to doing it again sometime in the near future.
Thanks for having us. Appreciate it.
Thank you, AJ.